Somewhere in almost every American town, there's a bank that never says no. It doesn't check your credit score. It doesn't ask why you need the money. It just hands you cash in minutes and tells you to pay it back on payday. But here's what it never puts on the sign out front. That quick yes can carry an interest rate close to 400%. This is the story of a loan built to be almost impossible to escape. Meet Kai. Kai delivers food across the city, racing from restaurant to doorstep, one order at a time. The pay is decent on a good day, but the good days aren't guaranteed. One afternoon, Kai's delivery bike breaks down. Rent is due in 3 days. The bank account shows $40, and payday is still 2 weeks away. That's when Kai notices it. A small storefront on the corner, bright lights, a sign that reads, "Cash today, no questions asked." Inside is what we're going to call the Future Eater Bank. It isn't a real company. It's a stand-in for a very real industry that runs thousands of storefronts across the country, payday lending. Here's the deal the Future Eater Bank offers. Hand over a piece of tomorrow's paycheck, and it will hand you cash right now. For millions of Americans like Kai, that trade sounds like a lifeline. For a lot of them, it becomes the first step into something much harder to walk out of than it was to walk into. Kai sits across from a smiling clerk. The application takes 10 minutes. No credit check, no proof of savings, just a pay stub and a bank account. Kai borrows $300 to fix the bike and cover rent. The fee is $45, which sounds small next to the $300. 2 weeks from now, on the next payday, Kai owes it all back at once, $345 in a single payment. That $45 fee is where the real story hides. Spread that same fee out over a full year, the way a credit card or a car loan gets measured, and it works out to an interest rate of almost 400%. The Consumer Financial Protection Bureau, the federal agency that oversees lending, says a typical 2-week payday loan with a $15 fee for every $100 borrowed lands right around that number. A typical credit card, by comparison, usually charges somewhere between 12 and 30% a year. Picture it like this. If Kai's paycheck were a loaf of bread, a credit card would ask for one slice off the top. The Future Eater Bank asks for almost the whole loaf, just stretched out so it doesn't feel that way in the moment. Kai leaves with $300 cash and a due date circled 2 weeks out. For now, the rent gets paid and the bike gets fixed. But the clock has already started on a much bigger question. What happens when payday comes and $345 is due, but the paycheck is already spoken for? Payday arrives and Kai's paycheck lands, but rent, groceries, gas, and a phone bill are already lined up to take their share, and there isn't $345 left over. The clerk offers a solution. Pay just the $45 fee again, and the loan gets stretched 2 more weeks. No new paperwork, no hard conversation, just $45, and the problem disappears for now. Kai pays it. The relief is instant, but the debt isn't gone. It's only been pushed down the road, and the meter never stopped running. This is called a rollover, and Kai is far from alone in choosing it. The Consumer Financial Protection Bureau has found that roughly 80% of payday loans get rolled over or followed by a brand new loan within just 2 weeks of the last one. A loan built to be a one-time fix quietly turns into a subscription almost nobody signed up for on purpose. Here's what that looks like in real numbers. On a typical $300 loan, a $45 fee every 2 weeks adds up fast. After 4 months of rollovers, a borrower has paid $360 in fees alone and still owes the original $300, according to the CFPB's own research. The bike is long since fixed. The rent from 4 months ago is long since paid, but the original debt is still standing there, untouched, like a shadow that keeps growing no matter how far the sun moves. It's worth asking a real question here. Why would anyone walk into the Future Eater Bank in the first place? For a lot of Americans, the honest answer is that the other doors are locked. The Federal Reserve asks people every year a simple test question. Could you cover a surprise $400 expense using cash or savings? In the most recent survey, about 63% of adults said yes, which means nearly 4 in 10 adults could not. A cracked phone, a trip to urgent care, or a broken down delivery bike can turn into a real emergency overnight when there's no cushion behind it. Banking access plays a role too. The FDIC, which tracks how many Americans can use the banking system, found that roughly 1 in 6 U.S. households have no access to mainstream credit at all. No credit card, no personal loan, nothing a traditional bank would approve. Millions more technically have a bank account but still lean on outside services just to get by. Kai fits this picture closely. Gig work like food delivery can pay well one week and fall short the next, with no guaranteed hours and no employer safety net underneath it. When income moves like a roller coaster, a 2-week loan can stop looking like a trap and start looking like the only door still open. This isn't a story about careless choices. It's a story about a gap in the system and a business built to profit from exactly that gap. If the Future Eater Bank is this costly, why is it still open for business almost everywhere in America? The rules simply aren't the same from state to state, and the federal rules have changed direction more than once. About 20 states, plus Washington, D.C., have capped short-term loan rates around 36% a year or banned payday lending outright. Cross into a state without that cap, and the same loan can carry an interest rate of 300, 400, even 600%. One real example shows how this can play out. Since 2006, a federal law called the Military Lending Act has capped interest rates at 36% for active duty service members and their families. Lending to military households didn't disappear under that cap. It just happens at a fraction of almost 400%. At the federal level, the Consumer Financial Protection Bureau tried building stronger nationwide protections back in 2017. That included a rule requiring lenders to check whether a borrower could realistically afford to repay a loan before handing over the cash. That requirement was rolled back in 2020. A smaller set of protections, mostly limiting how many times a lender can try to pull money from someone's bank account, finally took effect in March of 2025 after years of legal battles. The agency soon announced it wouldn't prioritize enforcing even those. The lending industry argues these loans fill a real need for people traditional banks turn away, and that stricter caps just push borrowers toward unregulated lenders or cut off access to credit entirely. Consumer advocates argue the loans are built to trap people by design, and that a national rate cap would end the cycle without shutting off access, pointing to the states that already enforce one. Both sides, at minimum, are arguing about the same 12 million Americans who take out one of these loans every year. The cost of the Future Eater Bank rarely stops at the fee on the loan itself. When a payment attempt fails because an account is short, banks often charge their own overdraft fee on top of it, sometimes more than once for the same missed payment. Payday loans usually aren't reported to the credit bureaus when they're paid on time, so making every payment rarely builds a credit score the way a credit card or car loan would. Miss enough payments, though, and the debt can get sent to collections, which can hurt that same credit score for years. It's a strange setup. Little reward for doing everything right, real damage for falling behind. There is a way out of this specific building, and it's worth knowing it exists. Many credit unions offer what's called a Payday Alternative Loan, a small loan between $200 and $1,000, with a rate capped at 28% a year instead of almost $400. Community organizations and local charities in many areas also offer emergency help with rent, utilities, or car repairs, aimed at keeping people from ever needing to walk through a door like this one. None of these options are perfect, and none of them existed for Kai in the exact moment the bike broke down and the rent was due. But knowing they exist before an emergency hits can change the entire equation. So what can you actually take from Kai's story? A few things, and none of them require a finance degree. Always translate a fee into a yearly rate before you borrow, even a small one. A $15 fee on a $100 loan sounds tiny, but turned into an APR, it becomes a completely different number, and that number is the one that tells the truth about the real cost. Look for the door before you need it. A credit union's Payday Alternative Loan, a small dollar loan from a traditional bank, or a payment plan worked out directly with a landlord, hospital, or utility company usually costs far less than a 2-week loan with triple-digit interest. Many billers would rather set up a payment plan than lose the payment altogether, but that only works if you ask before the due date passes. Even a small emergency fund changes the equation. It doesn't need to cover months of expenses to matter, because Federal Reserve research shows that having even a modest cash cushion is often what separates a $400 surprise from turning into a 5-month cycle of debt. Building that cushion, $20 or $50 at a time, straight out of each paycheck, is slow, but it's real progress. And if you're already inside a rollover cycle, it helps to know that some states require lenders to offer a no-cost extended payment plan instead of another rollover. It's worth asking directly whether that option exists before agreeing to pay another fee just to push the due date back again. Kai's bike eventually got fixed for good, paid off slowly, a little at a time, with help from a payment plan and a lot of tight months. Not every story like this ends the same way, and that's the honest, uncomfortable truth about payday lending. For some borrowers, it's a one-time bridge. For a much larger share, it becomes a cycle that's brutally hard to climb out of, not because they failed, but because the loan was built that way. The Future Eater Bank isn't a real building on a real street, but the industry it stands in for is real, it's legal across most of the country, and it does business with about 12 million Americans every single year. Understanding how a small fee turns into a massive rate, and how that rate can turn into years of catching up, is the difference between walking in with your eyes open and walking in blind. Money stories like this one are hiding everywhere once you start looking, inside credit card statements, car loans, and the fine print of a mortgage. This is just one door. There are plenty more worth understanding before anyone ever has to walk through them.